What's up, everybody? This is Investing Sensei here to bring you episode 142 of the portfolio update. So hopefully you guys are doing awesome. I definitely am. In this video, I have quite a bit of things to talk about to you guys in this video, so it's definitely exciting. In this video, I will be going over the portfolio. We'll go over the portfolio value, how the portfolio performed. We'll jump into the activities where I'll show you what I bought, what I sold, any dividends that came in, and then we'll jump into the Google Sheets and we'll kick off the scripts that I do have available for free, guys. But we'll make sure and see how much we grew this dividend snowball this week, because remember, we continue to dollar cost average into the portfolio no matter what it's doing. So by end of this video, we should see this much higher. Continue to dollar cost average no matter what the portfolio is doing, and we're still continuing to increase this because eventually at one point we're going to be able to live off of these dividends. Definitely not now, but maybe 10, 15, 20 years from now. This will be able to replace their income and hopefully a lot more. As you'll see that if we look at the quarterly dividends, these are just continue to increase and increase. We actually just finished Q2 of 2022. We ended up with $791.32. That is pretty sweet, guys. I think Q3 we're definitely going to go over 800. Remember that our goal for the end of the year, we're trying to average about $300 every single month. That would be pretty sweet. Annual dividends, we already surpassed 2019's, and I think we're going to surpass 2020's in the following quarter. So it'll be very amazing there for 2022. But as you'll see, the goals that we do have is that we're going to continue to dollar cost average into the portfolio $100 no matter what happens, and then we're also going to drip our portfolio, or I guess our dividends, plus an additional $20. We're trying to achieve about $300 on average per month, and then reach 6,000 subscribers, which we've already reached. We're heading towards 7,000. So if you're a new subscriber or you're a new viewer and you haven't subscribed, help us reach 7,000 subscribers by subscribing with that bell notification. And while you're down there, drop a big thumbs up on the video to help out the channel, guys. But yeah, thank you so much. Every individual of you guys allowed this to be, allowed it to happen. Yeah, this is pretty cool, guys. We got some goals for 2022. The last thing I do want to go over is somebody actually sent me their pie, their portfolio pie, and they wanted me to review it. So we're actually going to review it towards the end of the video. And if you guys do enjoy that, let me know in the comment section if you guys would like me to do more of those. I know another YouTuber named Dividend Growth Investing, which I follow, does these type of reviews for the pies. So definitely going off of them. Maybe they sent it to me. So if you are interested, and me reviewing your pies, let me know. I can do these more often, but definitely Dividend Growth Investing started this series, so I'm definitely not the creator of it. So all the shout outs go to him. I'll try to leave the link to his YouTube channel in the video description if you are interested in checking him out. I'll be going over review my pie for this subscriber, and we will see what happens. If I get enough interest, then I can try to add more of these towards, the Sunday videos, or maybe we could start a new series. You guys let me know in the comment section what you guys like as well. Depending on how I go over the review my pie, let me know if you want me to go into more details into a stock, like researching it and so on. But let's go ahead and get started, guys. So first thing, you'll see that the portfolio is at $174,691.50, guys. If we look at our buying power, we have $106.92. That's actually, we still have about $6.92. That's actually from a dividend, and the $100, I will be explaining that in a bit. But if we look at the time value over time, we look at the 1 day, you'll see that there's actually not enough data, but 1 week, there's 2.47%, so about $4,000 that we went up this week, and just capital appreciation. If we look at the 1 month, we're still down about 4.94%, which is about $9,000. Super volatile, the portfolio, and that is because I'm very heavy invested in tech, guys. If we look at the 1 quarter here, we're down about 14.85%, which is about $30,000, and we just been in a downtrend, guys. But over the long term, we're definitely going to be up much higher. If we look at the I guess 1 year, we're down 9.05%, which is about $16,000, almost $17,000, and as you'll see, super volatile. But overall, guys, for the full time that I've been investing, this actually only goes back all the way till November 2019, but I've been investing since January 2019, so we're still missing some most of the year actually. So if we look, we're still up about 50%, which is about $52,000, almost $53,000. But you'll see this little dip here, guys. That was a huge crash there. That was the March 2020 crash. And over the long term, we've been continue to dollar cost average, continue to reinvest those dividends, and we've been having all these little dips right here. They're pretty violent too, but in the long term they don't really look like nothing. It's almost starting to look like a straight line upwards, and this correction here, guys, or I guess it's not even a correction, but it is a bear market. This is great buying opportunities for us, and that's where we're going to continue to dollar cost average. Right now I'm trying to just get prepared, make sure that I have my emergency fund ready to go, and then I'm trying to save up a little bit of cash, but at the same time I'm trying to continue to dollar cost average to the portfolio, because we never know what the market will do. But yeah, that is the value over time. Let me show you guys the activities so that I can show you. There was actually nothing much this week that happened. If we look, it was actually the 4th of July, and really we deposited $100, and then we got a dividend from American Towers on the 8th of June, well, I guess July 8th. We got American Towers $6.92, and then we deposited another $120 on the 8th of July, and then we did 8 buys of $124.77. So we did $4.77 from Nvidia. This was the dividend they paid us out last week, so we just reinvested back into itself. We did $38 of Microsoft, $3 of Southern Companies, and $2 of Disney, $4 of Pfizer, $44 of Costco, $9 of McDonald's, and then $20 of American Towers because they paid us a dividend. And the reason why I did this, guys, is because I am trying to get to a full share of each company, and I'll show you that in the holdings in a little bit. But if we look at the calculate dividends, this is the script I did write. It adds up all the dividends. We made $6.92 in dividends for this week, doing absolutely nothing, almost minimum wage. So it's like we worked 1 hour passively at minimum wage. If we look, that was pretty sweet there. But if we look at the holdings, guys, you'll see if I sort this out by shares, I'm trying to actually get most of these. Well, I guess if we look at Disney, we're at 63 shares now. If we look at Microsoft, we're right at 80 shares. Pfizer, we're at 83 shares. I think the other one I bought was Southern Companies, which we're at 36 shares now. I'm trying to add up all of them to be full shares, and you know, if you know the reason why I'm doing this, let me know in the comment section. I'll be revealing it in a couple weeks, hopefully, and you know, maybe I'll tell you the answer sooner, but I am gonna wait a little bit. But there's a specific reason why I'm doing this, and yeah. But let's go ahead and jump over here to the Google Sheets so we can figure out how much we grew the dividend snowball, guys. I already went ahead and made the copy. We can actually go over here to dividend payout, and you'll see that the dividends for the month of July, these are it here. We're gonna get Altria's dividend, which is pretty massive, and ours, which is about on July 11th, and that's gonna be pretty sweet. Leggett and Platt on the 15th, Realty Income on the 15th, and then JP Morgan on the 31st. And then we did get 2 dividend raises this past quarter for these, but this is a script that I do have available for free, guys. Check it out. Maybe it's in the video description, but if not, I do have a video in the channel. But you go ahead and click portfolio tools, get latest dividends. If not too many people are running it, it should run fine. Takes a minute or two, but it'll figure out all the companies that declare dividends for you in your portfolio. So there it goes. It'll pick up any new increases from a company, and yeah, looks like it's done, guys. And this is what we have here. Lockheed Martin, I believe, is the one that declared a dividend, I believe. And then if we look over here to settings, guys, we can go ahead and delete this, which is another script I do have, but you delete it. Let's go ahead and jump into personal capital so we can grab the latest version of our portfolio from this purchases of this past week. Alright guys, so we're here at personal capital with my M1 account. You'll see this green button, click on it. That copies the content of your portfolio from M1 into the clipboard, which then you can jump into the Google Sheets, right click, paste special, values only. And then we can jump over here to holdings, and then this is actually our shares for the previous week of our portfolio. If you click portfolio tools, and when you click update portfolio holdings, this will get wiped and it'll parse that new string that we just pasted, and that'll be our new positions from this current week. So it's basically updated. So click update portfolio holdings, you'll see it get wiped. It's recalculating. We can jump over here and everything's getting added up, so we should see it much higher this week. And looks like dividend yield projected, it went down because the portfolio did go up in value, 1.87% compared to 1.92% of last week. Yield on cost still the same, 2.60. And then yearly we went up about $2 or so, and then monthly we went up about what was it, 14 cents. And then weekly we went up about 4 pennies. And then every day we're making 1 penny more, so that's pretty sweet. Hourly we're still making 37 cents every single hour. Hourly work wage, this is if our portfolio was to go work a 40-hour work week, they would get paid an hourly rate of $1.57 every single hour. We're gonna eventually try to get this to minimum wage. We'll see how long that takes, but I think eventually we will get to that. We're very close to $2, so you know, we just got a couple more dollars to go. Not really, but you know, we still have about what, $6 more dollars to go. But yeah, let's go ahead and this is actually all I have for you on the portfolio. Let's go ahead and jump into the portfolio review, guys, which a subscriber did send out to me. Let me know the format, what you guys would like to see more. This is my first time doing it, so if there's things that we can improve on, let me know. I'm assuming the portfolio is called Dividends, so he's mostly aiming towards dividends. There was not much, you know, much information of how old they were, so I'm gonna take some assumptions. We're here on holdings. There's 31 holdings. Dividend yields 4.338%. Expense ratio is about 0.13%, and so that means there's some ETFs. So let's go off the first one. So first one, we have SCHD, pretty great ETF. I actually did a video on it this past week, so check it out. They have this target to 10%. Can't go wrong with this one. And if we I'm actually gonna go back here. I accidentally clicked on this, but I'm gonna use Seeking Alpha just so you guys can see kind of the holdings. If we type in SCHD, and once this loads up, you'll see the performance. We'll just look at the year to date. It's down about 10.28%. If we look at the 1 year, it's down about 3.23%, but the 5 years, it's up about 61%. 10 years, it's about up 160%. And if we scroll down, one of the main things I want to show you is right here. So they're mostly in financials, technology, industrials, consumer, healthcare, but top holdings, we got Merck's, Pepsi, Coca-Cola, Verizon, Pfizer, Cisco, Texas Instruments, the Home Depot. So pretty great holdings that they do have. If we look at the 5-year CAGR, which is usually something that you want to look at, it's about 13%, which is amazing, guys. That means that they're going to be compounding, or you know, their raise is about 13% every single year, or in the past 5 years they've raised their dividend about 13% on average. So that is a pretty amazing one, especially if you have you know, a long-term time horizon. Double-digit 5-year CAGRs are amazing. Starting dividend yields about 3.88%, which is amazing as well. And they pay out quarterly, year of growth. They've been growing their dividend for about 10 years. So that's another thing. So SCHD is a great holding there. So definitely agree with that one. 10%, might even be able to bump it up higher. If we look at the next one, you got JEPI, which is 10%. I know this one's more of like a higher income ETF that they pay out more. So let's just look it up real quick. We can look at the holdings that they do have, and I'm not going to go through all the holdings because it'll take forever. This video will be super long, but let me know if you would be interested in something more like that. If we look at top holdings, Progressive, AbbVie, long on AbbVie, Bristol Myers, United Health, and then the Hershey's, Coca-Cola. So pretty sweet holdings here. Not too much. You'll see the dividend yield's insane, 13%, 2 years of growth. Nothing on the 5-year CAGR. So this is something that you might want to be cautious depending on what your goals is. Are you trying to live off dividends currently? Or are you trying to live off dividends in 5, 10, 20 years from now? Because one of the things you want to consider is, if you are trying to live currently, then definitely JEPI, SCHD, a lot of higher dividend paying ETFs, stocks, would be your goal there. But if you're trying to live off dividends maybe 5, 20, well, I guess 5, 10, 15, 20 years from now, you probably want to go with companies with a lower dividend yield, because lower dividend yield, but with double-digit 5-year CAGRs, so that currently you don't pay as many taxes, because closer towards you start actually living off these dividends, hopefully you start benefiting from the 5-year CAGR compounding, and then you'll start paying more taxes. Well, you'll get a lot more dividends, but you hopefully will not have an income, and so you'll be in the lower tax bracket at that point. So maybe that's something that you want to consider there. We have VYM, which is another Vanguard high dividend yield ETF. So definitely can't go wrong with these. You got QYLD. I believe this one's the covered call ETF one. So I think their dividend yield is also pretty high. Let's look it up real quick, just so while we're here. QYLD. And I can't really spend too much time on this analysis, because it'll make the video super long. That's the one thing I'm kind of cautious. Dividend yield's about 11%. So definitely it seems to me like you're really aiming for maybe potentially living off dividend yields, or I guess living off dividends right now. But I'm not 100% sure. They do pay out monthly. And they got Apple, Microsoft, Amazon, Tesla. These are probably the ones that they do the covered calls on. Nvidia, Meta, Google, all great holdings. Yeah, consider the tax consequences there. You got RYLD, covered calls again on the Russell. And let's see, we got DGRO. It seems like you have about 50% of your holdings within ETFs. Definitely cannot go wrong with that. I think that's a great thing. Just consider the adjustment that you have. A lot of these are high dividend yielding paying companies. If you are planning to start using this money now, go for it, but if you are not planning to retire now, and it's about going to be 10, 15, 20 years, potentially even 5 years, use lower dividend yielding companies or ETFs, so that you don't have to pay as much in taxes, unless this is in a taxable advantaged account like a Roth IRA. Then you can go ahead and go with that. And then I'm assuming the rest of the 25 holdings are in individual stocks, because it looks like you have them all by 2%. And if we look at these, you got Vici, we got Visa. Visa is a good one. It's a lower dividend yielding company with a 5-year CAGR. That's amazing. We got Starbucks. Definitely like Starbucks. We got Union Pacific as well. Texas Instruments. We got Target. T. Rowe. I know a lot of my subscribers like T. Rowe, especially they think it's undervalued. I'm not currently invested in it, but definitely don't mind looking into it. We got Pepsi. We got Realty Income. we got McDonald's, we got Lowe's, we got Lockheed Martin, and then we got Morgan Stanley. I believe Morgan Stanley has just been selling off, so might be a potential value there. The Home Depot, JP Morgan, Johnson & Johnson, a lot of companies that I do hold, which are great for the long term. We got Broadcom, AFLAC, AbbVie, 3M, and then Pfizer, and we got Microsoft, Apple, Bank of America, and Altria. Altria has been selling off, so great starting dividend yield there. But it looks like you have a lot of companies that are already covered by your ETFs that you are invested. So maybe you might consider potentially reducing some of these holdings, since some of the ETFs already hold a lot of these companies, and maybe focus into certain companies that you're very bullish, like Microsoft. Let's say you're very bullish on Microsoft in 5-10 years from now. Definitely, you might be able to put more of your money there into Microsoft instead of dividing it all by twos, and so you might get a higher return with Microsoft or Apple compared to 3M, because 3M's there's not going to be much growth compared when you compare it to Microsoft or Apple, or even Lockheed Martin. We got Target, or Visa. So there's a lot of companies here you might be able to reduce, because you do have a lot of overlap with the ETFs, and you can't go wrong with ETFs, guys. So definitely great portfolio. Might consider reducing some shares because they're already covered by the ETFs, and consider your long-term goal. Are you planning to live off dividends currently? Because it seems like you are, or you're trying to achieve a high income from dividends currently, and it seems like that's what you would get. So just figure out what your goal is. If you're not planning to live off of them right now, maybe consider waiting on that high income ETFs as well as the high dividend yielding companies, because at the end of the year, when you got to do your taxes, you're going to have to pay off quite a bit of taxes. Even though they do become qualified dividends, it's just money you could reinvest instead of paying taxes there. That is my what I see from this. This is not financial advice, so definitely don't take it with a grain of salt. I'm just looking at the portfolio. I'm not a full professional, or I'm not very experienced with it, but that's what I see. Let me know in the comment section if you guys want to see more of these. What would you want to see? Would you want me to dive into each individual company? Would you want me to do more research on each one, or just briefly look at them? And but hopefully you guys enjoyed it. If you stuck all the way to the end, be sure to drop a hashtag review, because we started doing a review this week. And I will catch you guys in the next video. Again, be sure that you're subscribed with that bell notification, and drop a big thumbs up on the video. I will catch you guys in the next video. Take care, stay safe out there. Bye, guys.